Hello, and welcome to the September edition of the Corporate ESG 5 and 5 podcast, the podcast in which we spend 5 minutes exploring a key ESG trend set to shape the market this month. I'm Jaspreet Singh from the US Capital Markets team, and I will be taking you through this month's key focus. In August, President Biden signed the Inflation Reduction Act into law, representing the biggest package of climate investments in US history. While the bill is aimed at reducing inflation, lowering healthcare costs, and creating jobs, crucially, it will invest $369 billion in climate solutions, representing an historic step for the US on climate change. With this, we wanted to focus this month on 5 key takeaways on this new legislation, including the climate contents of the bill, the impact it could have, key concerns, considerations for issuers, and finally, considerations for investors. So let's kick off. Firstly, what's under the hood of the bill? The bill would inject at least $369 billion into the US clean energy economy, with a good chunk going towards the power sector. It offers tax credits in the region of $260 billion for mature sectors such as solar, wind, and nuclear. It also incentivizes newer technologies like hydrogen and carbon capture, though at a smaller scale. Also included are incentives for consumers looking to invest in green technology. There is a home improvement credit, which allows households to deduct 30% of the cost of investments, like heat pumps or installation, from their taxes. Those looking to replace their cars with electric vehicles can benefit from tax credits depending on income eligibility. Interestingly, the Inflation Reduction Act also earmarks $60 billion in environmental justice priorities to help disadvantaged communities monitor and clean up pollution while building resilience to the consequences of the climate crisis. So, how good is this bill? Analysts predict that the Inflation Reduction Act will result in a 41% reduction in US emissions by 2030 compared to 2005 levels. While this is an improvement from the projected 27% reduction that would have happened regardless of the bill's passage, it falls short of the Biden administration's commitment to reduce emissions by at least 50% from 2005 levels by 2030. The act, though, does mark a radical shift in US climate action by putting emissions firmly on a downward trajectory. However, the US will need to implement additional policies to reach its proposed 50% reduction target. So, are there any concerns about the bill? Like much of what happens in Congress, the Inflation Reduction Act is a compromise. The legislation also includes a provision that tethers offshore wind leasing to oil and gas extraction. Over a 10-year period, the Department of the Interior will be prohibited from issuing a lease for offshore wind development unless at least 60 million acres have been leased for oil and gas in the previous year. This means if the Biden administration wants solar and wind on public lands, it must offer new oil and gas leases first. So what are the key considerations for issuers? It's important to note that the Act does not include any requirements for corporate issuers in terms of their disclosures, nor do the identified activities for federal investment actually form the foundation for any US taxonomy. However, companies in the renewable space that are active in the US will likely see increased investment opportunities in the US market. This can increase the scope for green finance issuance. Furthermore, the Act raises awareness of key concepts around sustainable finance. For example, there is considerable focus on disadvantaged communities, and climate justice issuers may expect investor questions on these topics regarding the overall implications of their sustainability strategies or around projects including use of proceeds bonds. Corporates may also want to consider how their sustainability strategies and targets incorporate these ancillary considerations and confirm related disclosures are sufficient. And finally, what are the key considerations for investors? The supply of investable green assets is expected to increase, providing greater diversification opportunities to investors. This will likely lead to the tightening of the greeniums observed in the label bond markets to date. Thanks for listening to this month's Corporate ESG 5 and 5. I hope you found it useful. As always, please be sure to check out our monthly newsletter, linked in the description, for more on the key ESG trends shaping the market this month. And if you like this episode, please follow the channel and click the notification bell so you can get future episodes as soon as they are released. Thanks again, and see you next time.